Debt funds, the forgotten alternative to the fixed deposit. Good morning, investors. Let me ask you something. Where do you keep your safe money? I already know the answer. Most of you said fixed deposit. And I completely understand. FDs are familiar, comfortable. Your parents use them. Your grandparents use them. No surprises, no stress. But today I want to tell you about something that most investors completely ignore, and that quietly does a better job than the FD in many situations. They are called debt mutual funds. Now, before you say MV, mutual funds are risky, let me stop you right there. Debt funds have nothing to do with the stock market. They do not invest in shares, not even 1 rupee. Instead, they lend your money to the government, to top companies, to banks, and earn interest on it. That interest comes back to you as returns. Think of it exactly like an FD, except more flexible, often more tax efficient, and in many cases, giving you better returns. Liquid funds. This is for your emergency buffer, your idle savings, money you might need any day. A liquid fund earns more than your savings account, and you can withdraw within 24 hours. No lock-in, no penalty, no paperwork. I always tell my clients, instead of keeping 2 or 3 lakhs sitting in a savings account earning 3.5%, park it in a liquid fund, same excess, better return. Short duration and corporate bond funds. These are for the money you park for 1 to 3 years. If you have an FD maturing and you are wondering what to do with it, this is worth exploring. Returns are comparable to FDs, sometimes better, especially when you factor in taxation. Good for planned goals, a vacation next year, your child's fees in 2 years, or simply building a stable debt cushion alongside your equity investments. Dynamic bond funds. These are managed actively. The fund manager adjusts the portfolio based on where interest rates are heading. When interest rates fall, and in India's current interest rate cycle, rates have been coming down, these funds can do particularly well. Best for 3 years and above, not for very short-term parking. Now, are debt funds completely risk-free? No. I'll be honest with you, they are not guaranteed like an FD. There is some credit risk. If the company the fund lent money to has problems, it can affect returns. And there is interest rate risk. When rates rise, bond prices fall temporarily. But here is the simple rule to stay safe. Stick to funds that invest in government securities or the highest rated companies. Check the credit quality before you invest. Your distributor can guide you on this. The real lesson. FDs have their place. I am not asking you to abandon them. But keeping all your safe money in FDs alone, especially when interest rates are not very high, means you are leaving better options on the table. Debt funds give you flexibility, liquidity, and in many cases, better post-tax returns. My WealthWise pin-up rule for today. An FD locks your money and your thinking. A liquid fund keeps both free. Tell me honestly, how much of your money is sitting in FD right now? And have you ever tried a liquid fund or short duration fund? Drop a comment, let's talk. I'm MV Suresh, founder MV Suresh WealthWise. For regular mutual fund updates, connect with me on Facebook, Instagram, LinkedIn, YouTube and Telegram. Wishing you good financial health. I'll be back tomorrow with a new tip. Till then, stay wealthwise.